Welcome, guys. We have to deal now with the statement of cash flow. Like we are seeing here that the objective of IS 7, which is the statement that regulates your statement of cash flow, it says that it requires you to present the information about historical changes in cash and cash equivalents of an entity through a cash flow statement. Now, the cash flow statement classifies the transactions into three categories: operating, investing, and financing. Right, meaning these ones are here. Okay. Now, IS8 requires all entities to present a statement of cash flow in its financial statement. An overview: all entities must prepare a cash flow statement. So in short, the statement analyzes the changes in cash and cash equivalents during the period. Okay. Cash flows are inflows and outflows of cash and cash equivalent. Cash comprises of cash on hand, demand deposits. So cash and cash equivalent refers to short-term, high liquid investments that are readily available or readily convertible into known amounts of cash and subject to a significant risk of changes in value. So we're looking at what is short-term. Usually short-term in accounting is something that is up to a year, 1 year, meaning 12 months. Okay. Presentation of the statement of cash flow. Cash flow must be analyzed between operating, investing, and financing. Like I said, that there are three major elements. Right. Now, operating activities are the main revenue producing activities of the entity that are not investing or financing. So operating cash flows include cash received from customers and cash paid to suppliers and employees. So there we are talking mostly about the activities that affects the income statement. Right. Then we go to investing activities. Investing activities are the acquisition and disposal of long-term assets. So that is where you dispose your PPE, where you bought, when you are buying your PPE, you also include them in that part. And it says, and other investments that are considered to be cash equivalents, meaning if you've got investments, you can also put them in that category. Where the information is available, cash paid to acquirer, PPE should be distinguished between the relating to replacement and that relating to additions. So in short, they're saying if you've got sufficient information in the question, you should be classifying your, let's say your PPE, you should state if it is you are replacing a certain basically asset or you are acquiring more. Right. Financing activities are activities that alter the equity, capital, and borrowing. So in short, it is what you use to finance the investing activities in most of the time. Right. Interest and dividends received and paid may be classified as operating, investing, and financing cash flows, provided that they are classified consistently from period to period. Cash flow arising from taxes on income are normally classified as operating unless they are specifically identified with financing. Right. For operating cash flow, the direct method of presentation is encouraged, but indirect is acceptable. Right. The components of cash and cash equivalent should be disclosed and a reconciliation presented to amounts reported in the statement of financial position. Netting off of cash flows. All cash flows should be stated on a gross basis, meaning you don't offset. That's what they are saying. Now let's look at class example 1. Right. We've got class example 1, which is money limited. And you've got your statement of financial position presented there. Your statement of comprehensive income also presented there. Then our additional information is stated. Right. What are we required to do? We're required to do the statement of cash flow using the direct method. And secondly, to prepare the note to reconcile the profit before tax to the cash generated from operations. All right. Now, the first thing that I want us to do is to calculate this. That is our number one. We must calculate this. Okay. Now, what do we look for? One, we look for the turnover or the revenue, which is this one. We look for that one. Okay. That one, I'm going to use the T accounts in explaining this thing. Okay. Now, in explaining this, let me use the T account. Here we go. So here is your turnover. All right, I'm calculating the cash received from customers. Here is the turnover. Now, what we need to do is to get opening balance of trade receivables and closing balance of trade receivables. These amounts must always be at gross, meaning they must be, they must never basically include provisions, because remember, how do you deal with trade receivables? Trade receivables, if we assume it is debtors, the way we know how to do it every time in accounting is that what we do, we'll say trade debtors minus provisions. So these figures, the ones of opening and closing, must always be excluding the provision. If in a question it is presented that the provision has already been deducted, you must add it back. Okay, I will show you in the next exercise what is it that I'm saying. Right, let's look at this one. We've got in the question now, let's look at this thing in the question first. Your question says, here is your trade receivables. So 14 is opening, 17 is closing. But now be careful when you deal with that, okay? These two figures. Be careful because they're already at net, these two. I'll show you why I'm saying they're at net. And that is what I was saying, that you should not use the net figures, use the gross. They're at net, these ones. Let me show you where they come from. Here they are. Right. You'll see, if you look at 2018, 17 minus 3 million is 14, which is the one that you see here at the top. Right, this 14 here at the top. Okay. The 17 comes from the 19 and the 2, so that gives us 17. Now, like I said, we use these ones. These are the ones before deducting the provision. So those are the ones that we want. So the ones that are shown on the statement of financial position, they are net. They are after deducting the provision. So we don't work in that fashion. We work with gross amounts, not after deducting the provision. Okay. Right, let's check. Here we are. Our opening is 17, which is the gross. Then our closing is 19. Then we add the debit side, which is this side. It gives us the 121, 68,000. We minus the 19. Then it tells us that our cash received from customers is 102,208,000, right? Which is this amount here. So in this one, I'm trying to use the T accounts so that I can then demonstrate to you guys how that it's done. Okay. Now, let's then check again now the next one, which is this one, in terms of how it's calculated. Now, in this question here, I'm talking about this calculation here, right? You'll see I've added a certain column there, but I will then explain to you it's because it's very important, especially these amounts here that are included there, right? So that you can understand exactly what we are doing, right? Okay. Now, these are the amounts that we have. Now, you'll see I've created two columns there so that I can demonstrate what I'm trying to calculate. Now, let's go up so that we can, I'm going to address these two figures first so that you can understand what is it that I'm saying. Right. we are here. Now, you've got revenue here. If you deduct this amount or you subtract this amount from the revenue, in between there, from revenue to profit from operations, what is it that is in between? You'll have your not sales, there will be cost of sales. Then after having cost of sales, obviously you'll then have your gross profit, because revenue minus cost of sales gives us the gross profit. And then you've got other income, you've got other expenses. But now be careful. If I take this figure here and I subtract it from this one, it gives me all those things: your cost of sales, your other income, your other expenses. They are there in that difference, right? Now, but if I take this figure here and I minus this one here, it will then mean it is cost of sales, other income, other expenses, and then including these two now, the investment income and the finance charges, if I use this one now. So let's go back to what I was saying that side. Here. Right. You see, if I minus profit from operations, I get this one. But it will exclude these two that I've highlighted there, which is zeros. It excludes them because these two come after this figure here. If you look at the statement of comprehensive income, they come after. They can never be included in the difference because they are not part of the amount. You will see it here. If I start here, then I subtract this one from here, right? So it can never include the ones that are after the highlighted one, because I've stopped at the top. The 758 and the 57,000 for finance charge, they are after the 5330,000. So that difference can never include the two. But if I use this one against this one, it will include the two. Because you can see now, the 6031,000 is after the 75857. So it will include them. So now, let's then go back to the calculation now. Now, we're here. If we use the 6031, we get this figure. You will notice that when we go to non-cash items, here are the two. Now, they are there under non-cash items because we are using 60, which includes them. But the 50 does not include them. That is the reason why you've got the zeros here under non-cash items, okay? That is step number one in calculating that. I was trying to show you that you've got two ways in relation to this question in terms of how you can calculate. So it's very important to understand that if I use this and this one, it excludes the two figures below, 758 and the 57 in bracket. But if I use this one and this one, it will include them, okay? And the difference that I'm getting, it is cost of sales, other income, other expenses, investment income, and finance charges if I use this one, right? But if I use this one, it excludes investment income and finance charges, okay? All right. Now, let's go and look at the description. The description there is clear that if I take this minus this, I will have cost of sales and other expenses. Also, another income is included there, okay? Also, other income is included there. So that's the correct description. And then cost of sales and other expenses, again, if you minus that, this figure here will also, now it will be your cost of sales, your other expenses, your other income, your finance charges, your investment income. They are part of that figure once you do that, okay? Then we say, fine. Now, let's identify these 9 cash items. Let's identify these 9 cash items. For an example, in this exercise, we've got depreciation as a non-cash item. we've got a provision. Now look at the difference. In the provision, look at the difference. It's going down. It is from 3 million to 2 million. It's going down. It's creating an income of 1 million. Okay. We've got that provision. And then let's go and check in terms of that calculation. There we go. So on both sides, we will minus the depreciation. Remember, the depreciation is a non-cash item and it's included here. If I want to take it out, I must minus it from there. Okay, here it is. Even on this side, I can do the same thing, right? Then you've got your profit on disposal of assets. Already we've touched this 1 million. Okay, let's deal with that. 38,000. Profit on disposal of asset. The profit on disposal. Now, here it is. Operating profit include the profit on disposal of asset of 38,000. Right. We have that 38,000 gain. That's the one that is included here. Now remember, this is an income. It goes, or it reacts opposite of an expense. The depreciation you can see is in bracket. The income will not be in bracket. So this one is also an income because it is decreasing from 3 million to 2 million, like I've explained before. It's an income. You'll see here it is decreasing from 3 million to 2 million. So the movement in your income statement or in the statement of comprehensive income is 1 million. Right. And then you will see that in this one we're going to put these two because we took this amount, which is after the two figures, and then they form part of this calculation. So one is an income, it reacts opposite to an expense reacts the same. Finance charges and depreciation, you can see they react the same. All the incomes react differently. Okay. Now we've moved further down in terms of this. Then we go to accruals. So you'll see you've got opening and closing there. The opening is the 5064,000. The closing is 6670. This is where it comes from. The accruals, they come from here. Okay, they react the same as trade payables because accruals and trade payables are the same. And if you look at that, you'll remember that accruals technically you can say they're non-cash because it means you have not paid them. You still need to accrue them because you've not taken them into account. So they are forming part of these figures here and they have not been paid for. So they went up from 5 million to 6.6 million. Okay, so the increase, you reverse it out of that. Okay, then you've got your inventory. Again, under inventory you've got your opening and closing. Right, opening, and just for simplicity's sake, this one, if it is this amount represent the 5 million will go to the credit side, the 6 million will go to the debit side, and then that will represent an inflow in terms of your books, the 1.6, right? This one, the opening is 15 million on the debit side, the 15 million 15.1 debit side, 15.9 credit side. Then it goes, the 15 goes to, let me see, yeah, 15 will go to the credit side now. 15.1 debit side, 15.9, that will be your credit side. So you've got an additional 833 that you've bought in terms of the inventory. This is the 833 that you've bought in terms of the inventory. So this represent an inflow. Right. So now 833, that is the difference. Then you get to look at the trade and other payables. Your opening is 89, and you will credit the 89, which is the no opening is 10. Opening is 10. You'll credit 10 119. I'm talking about this one. You credit it, and then you debit the 8991. So you then have to balance the debit side. That is an outflow. So this is an outflow, right? Now, then we then add the figures here. If I take this figure minus my non-cash items plus my movement in working capital, it should give me this figure here. So this figure here is made out of all these three: this one, and this one, and this one. Right, they give me the 355. Right, then you add these ones, then you can get that. Right, on this side they take this minus this minus that plus that, then it will give us this figure here. Then you must not change your figures. When you're done, you put the amount here. Okay, right, so on that face of the cash flow, obviously this one is given. It's on the face of the statement of comprehensive income, and also this one is given on the face of the statement of comprehensive income. Right, what I want to do, I want to entertain the two figures that will follow after this one. Let's deal with dividends. Dividends, it's this one here, shareholders for dividends. Now this account here, shareholders for dividend. What is our opening? Our opening under shareholders for dividend, here's shareholders for dividend. Our opening is 0, then our closing is 33. Right, let's check. Something doesn't make sense here. This is 0 and 32. This one is 33. Then that means we need to fix something there. Let's see. 386. Yeah. So that should be 32. I think this one must change to 32. So it makes sense because then it won't tie to this one that I see here. If we don't do that. Yeah, so it should have been fixed in that fashion. Right, let's then go and deal with shareholders for dividend. There we go. Opening is 0, like it's given there. Our closing is 32. The dividend that has been declared of 418, which comes from here, here's the 418 dividend declared. Okay, so in short, it is the opening that will go on the credit side, the 32 will go on the debit side, the 418 on the credit side, and then you should then calculate your figure there. Let's go to it there. 0, 32, then the 418, then we balance the credit side with 418, then the difference between 418 and 32 is the 386, which is our cash that has been paid for dividends. This is the amount here that I'm talking about. Okay, right, it's an outflow of money. Since shareholders for dividend is a liability, if you're balancing the credit side, then that represents outflow. Taxation, let's deal with taxation. Now in this exercise you'll see that there are two things here. There's two, right? There's SARS and deferred tax. Okay, now this is how we deal with this thing. Let's start here. Right, here you've got two accounts of SARS. There's 125 sitting in trade receivables as opening, you see. So this will become a debit. It will be on the debit side in this SARS account as an opening amount. And the 32 will be on the debit also as a closing. Opening is in the debit side because it's sitting under receivable. Be careful because it's under receivables, right? And then it means SARS owes us this much. And then 32, by end of 2019, we owe SARS now 32,000, okay, by 2019. Now, so this will go on the debit side in the SARS account, and also this one will go on the debit side, right? Let's check. Here we go. 125 debit and 33 debit. Oh, sorry, I changed the wrong amount. This amount was not supposed to change. I was supposed to keep it as 33. Then I misread that one because this one, yeah, shareholders for dividends is correct, 0 and 32. So I changed the SARS one while I was not supposed to change it. So it should be 125 and 33. Right. So here it is. 125 debit opening balance and credit closing. Right. Then what we need to do is to raise this one, which comes from the statement of comprehensive income, right? Raise the income tax expense. Here it is. Right, we raise the income tax expense. Right, then once you're done in terms of raising the income tax expense, now what you then need to do now, you balance this. This one is bigger than the other one. So if you balance, you need this much to balance, okay? This represents an outflow of 1887 triple. This is an outflow, okay? Then we go to deferred tax now. Deferred tax and deferred taxation. There it is. But now be careful. Do you see it's sitting under non-current asset? So it means these are debit balances. So this is what we call a deferred tax asset. Okay. So our opening is 24, meaning it's a debit. Then our closing is 955, which is still a debit. So we need to put these figures on the debit side, both of them. Okay. Let me just check. 24 we debit. No. The 955 we have to credit. We have to credit, not debit. So we opening, we debit. Right, 2474. Then the 955 we credit, because from here, remember, if something is sitting here as closing here, it will become opening the following month on the debit side. It comes to, it crosses over to the debit side, and then it will then agree to this. It will then agree to this. If you do that, then it will be this debit here. Okay. So now then we deal with our deferred tax now. So if this side is bigger, I will then have to minus this one, and then that gives me this one. That then symbolizes an inflow. This one is an inflow. This one is out. This in. Okay. Then I take the difference between the two, the inflow and an outflow. It gives me 368,000. Outflow. Okay. Outflow, which is this one. Right. which is this one here, 368, right? So we are dealing with these figures as we go along one by one, right? Then we come to cash from investing activities. Okay, cash from investing activities, we will deal with the 44,000, replacement of computer equipment and office equipment. Let's deal with the 44,000 first. Now, here we go. According to the information that we are given, we've got an opening of 492 and a closing of 345. Opening, debit side, closing, credit side. Right, let's go and check. Okay, we might as well also take note of the depreciation, which is 185. Ne? That will go to the credit side of that note. Okay, the depreciation. Now, here it is. Opening, closing. This one goes on the debit side. This one goes on the credit side. And this one also goes on the credit side. Right. And then we read this note here. It says computer equipment, this one here, with a carrying amount of 6 and vehicles of 2, meaning 8,000, has been sold. It must go on the credit side. It must be removed in the books. Okay, the 8,000 on the credit side. Right. So here we go. How much is that? Okay, we've got the opening, we've got the closing. So we've got the opening, we've got the closing, we've got the depreciation. Right. And then, why am I saying 6 there when I think I was saying 8? Let's go back. Computer, no, with a carrying amount of 6. Oh, the other one is a vehicle, the 2,000. So it doesn't affect us in that account of computer equipment and office. So the 6, the 2, sorry, it's for vehicle, so it's 6. Right. So if we then have to balance this one, this side will give us 536. Okay, then I will minus the 492 from the 536. It gives me 44 here, which tells me that I've acquired computer and office equipment of 44,000, which is an outflow, which is this amount here. So it's this one here. Okay, then we go to vehicles, the replacement of vehicles. Replacement of vehicles, again, you'll deal with, just hold on there, let me show you the same process. Here's the depreciation that deals with vehicles. Here is your opening and closing. Debit the opening, credit the closing, and then you've got your depreciation, and then you need to put the disposal of 2,000. Right, let's go. Although the bigger problem with such a long question is that I will keep going up and down. Here's the opening, here is your closing, this is the depreciation that I've noted, this is the 2,000 of the one that is disposed. Then I will balance this side with 2,685. Then I will less the opening, and then it tells me that I've acquired vehicles of 1040. Right. Your buildings here at the top, nothing happened here. You can see there was no acquisition. Sorry, there was no additional acquisition or anything. Okay, because it just balances itself. You've got the depreciation that will read from the top. The opening and closing are given to you at the top. Okay, so you will then have to put this one here. Okay, so for the building, there's nothing happening. I mean, if you look at it, here's the depreciation that we were using. You've got your opening and closing that are stated here. So you debit this one, you credit this one, and then you credit this one, they balance out. So there's nothing that happened under buildings. Right. The last item that you see is plant and machinery. Right, let's then deal with plant and machinery. Let's deal with the easy one. The proceeds that you've got. Proceeds from this thing. Right. So if you look at this, it made a profit of 38. Right. Made a profit of 38 on disposal of assets. And how many did they dispose? These are the two that they disposed at the top. So they make up 8,000. The gross, the carrying values are 8,000. If you have to make a profit of 38, it means you paid more than 8,000 by 38. So the amount you received should be 38 plus 8, because that is how much you received for them. Right. There is a calculation that I did for that. This one here. So the profit is this one. The carrying amounts are 6 and 2. That will give us 46,000 that was paid as proceeds for the sale of these assets. Okay. Right. Then we go to this one is sorted now. This is a receipt. You'll see it's not in bracket because we are receiving money now. Okay. Let's deal with this one, which is the last one under investing activities. It is plant machinery. Plant and machinery. So the depreciation of plant and machinery is this one. And then the opening and closing are these ones. Right. Let's then get to the T account. In the T account, you've got opening here, closing, the depreciation, this side, then you balance this one. So the credit side is bigger than the debit, so you minus this one, then it will tell you that you acquired plant and machinery of 327. Okay, so you've got your 327, which was the last figure that we dealt with, and then cash from investing activities. Then we go to cash from financing activities. Right. So your cash from financing activities is 25,000 outflow. Let's see. It should come from an easy figure here. Let's see. 69 minus 44. What do we get? Because the opening credit side is 69 minus the 44 that will sit on the debit side, so it's 25,000 your movement. So your liability is going down. So that represents an outflow of money because you are paying a debt. You are paying that liability, right? Let's see if I did by any chance remember to put it. Oh, here it is. Opening 69, closing 44. Then this is an outflow of money 25,000, which is this one here. This one here. Okay. Now your cash and cash equivalents, they're given to you. This one you'll get it from these two, the beginning and the end. These two are given to you in the question itself. Here they are. The opening, the beginning one is the 9762, the closing is 11. So now what most students do, they will then say, okay, I know my end figure is this one and I started here. Then they minus. From 11 they minus the 9, then they get this one. So for the sake of when we are writing, remember, you can write this figure. But if there are items that will be missing here, you won't get the mark here. Because how we do it, we'll say we'll add this, we'll take this one, and then we'll take this one, and take this one. If when writing you miss one of the items, let's say you didn't put this one here, so there's no way you're going to get this one. If let's say this one is not there, because obviously this one won't add up to the right amount. So we'll mark you wrong here. If you put 2140 000, but this one is missing here. Let's just do that. And this one here is missing here. Okay, so just know that when we calculate this figure, we're going to take this one and that one and that one. If yours don't add up to this figure here, this one you lose a mark, the one I've highlighted now, you lose a mark, even if you put the right figure there, the 2140000, because we will tell you that you're missing one item. So there's no way when you add the 3 you'll get that one. Okay, so that is the situation with that one. Then let's deal then with this one, the reconciliation, which is required to profit before taxation. It's given to us. We've used it before. It's this one here. Here's profit before taxation. Right. And then, now what are we reconciling to? We're reconciling to this figure here. Now, we want to reconcile back to that figure. No? Now, starting point is the profit before tax. Then what we say, okay, now what we want to do, we want to add back the non-cash items. Right. Remember, by the time we are here, we've already minus depreciation, so we put it back because it's non-cash. We've already added investment income, we minus it. We've already added, we've already taken it out, the finance charges, we put it back. We've added this in income, we take it out. We've also added it in income, we take it out. Right. Then we go and then say, okay, inventory, what did we say in inventory? Inventory, that was an outflow. Right. Is it an outflow? No. Let's check so that we become satisfied. This can be okay, inventory, our opening is 15, which goes to the debit side. Our closing is 1593, so the credit side is bigger than the debit side, so we need to balance the debit side. If we balance the debit side, it becomes an inflow, not an out. An outflow is on the credit side of this account. Right, so it becomes an inflow. Right, here we go. Your inventory. Decrease in inventory. Let me just read this thing. Something doesn't make sense here. It can never be that when it says decrease in inventory. Is the inventory decreasing? No, it's not decreasing. It's increasing. Unless I'm reading this thing wrong, because from 15 to that, it is an increase. It's not a decrease. It's an increase in inventory. Right. Yes, it is an increase in inventory. I agree with that. This one is not labeled correctly. Where is it? Where is this thing that is not labeled? Yeah, this one. It can never be a decrease. It is an increase. Increase in inventory, which represents an inflow. Then trade, let's check trade payables. What's happening to trade payables? Trade payables opening is higher, then there's a decrease, so it's decrease. So your trade payables are decreasing. So opening is that side. Opening is on the credit side, under trade payables, credit side. The closing, this one goes to the credit side. This one goes to the debit side, and then we balance the debit side. It's an outflow, this one. Outflow. It's an outflow, this one. Outflow. The 11. This 11 is an outflow. Okay. Increase in accrual. Is that an increase? Let's check. Our accruals, where is it? Where is this calculation? Accruals from 5 to 6. Right. So it's an increase, that one. It's an increase. in accruals. But this one is a decrease, cannot be. Okay, so this one is a decrease in trade payables. So your accruals are increasing. It's an inflow, this one. Right, it's an inflow. Increase in trade receivables. That should be an inflow. This one. Is it increasing? Let's check. Yes, our inventory is increasing. That should give us an inflow. No, this is trade receivables. What am I saying now? Trade receivables. What is happening to trade receivables? I can read it from here. The opening is this one. The closing is that one. So that is an increase. 127, 123 minus 19, 480. So it has increased by 2353,000, and it means we balance the debit side. If I compare only these two, if I compare this to that, it means I must balance the debit side. It can never be. And so if there's a balance, if we balance this side, that means we're getting money. If you're balancing this side here, if we balance this side, it means the debtors are paying, so we're getting money. If you balance this side, it means your debtors are increasing, you're not getting money. It's more like an outflow, right? So this is the increase. It's an outflow, right? Then if you add all these, they give you this figure, which then therefore agrees to this one here. So then you've got your statement of cash flow, and you've got your reconciliation, which agrees to the net cash from operating activities, which is this one here, right? So in some instances, some people they highlight this part here, like in this way. It's just so that you can see what is it that is supposed to be highlighted there. So that is the first example that we are dealing with in relation to cash flow. Thank you.